let's dive into the wild, paradoxical world of global asset management. A brand new report for 2025 paints a picture of an industry that, on the surface, looks like it's on top of the world. But if you scratch just a little bit deeper, you'll find a massive, and I mean massive, transformation is happening right under our noses. So get this, in 2024, the total amount of money managed by this industry hit an absolutely staggering all-time high, $128 trillion. I mean, just let that number sink in. After a pretty rough patch in 2022, a 12% jump like that looks like a huge comeback. But here's the thing, that number, it doesn't even begin to tell the whole story. In fact, that record-breaking number is masking a much trickier reality. As the report says, this growth can't hide the deep structural challenges the industry faces. We're talking shrinking profits, fierce new competition, the whole shebang. So you gotta ask, why is this record high so shaky? Well, it really boils down to two major cracks in the foundation. Okay, crack number one. Where did all that growth actually come from? You might think it's from tons of new clients flocking in, right? Nope. A whopping 70% of it wasn't from new business at all. It was just the stock market going up. That means the industry's health is kind of dangerously tied to the whims of the market, with only 30% of its growth coming from actual new money. And that brings us to the second, even bigger crack. It's about where we, the investors, are choosing to put our money. And folks, this is a seismic shift. We pulled 100 times billion dollars out of those traditional high-fee, actively managed funds. And at the same time, we poured an unbelievable $1.6 trillion into cheaper passive funds. That's not a trend. That's a revolution. And it's putting a massive squeeze on profit margins everywhere. So that raises the big multi-trillion-dollar question, doesn't it? With fees getting squeezed and investors voting with their wallets, how on earth does this giant industry reinvent itself to actually stay relevant? Well, it turns out the industry isn't just sitting back and watching this happen. They're fighting back. The answer lies in three incredibly powerful forces that are completely rewriting the rules of the game. These are the core strategies they're using: rethinking products, getting bigger through consolidation, and getting radically more efficient. All right, let's break down that first force. It's basically a revolution in the products themselves, as firms race to build new tools for a whole new world of investing. A perfect example of this is the rise of the active ETF. This is a real game changer. It basically gives investors exactly what they want. You get the brain power of active management, but it's wrapped in a low-cost, easy-to-trade package. Performance is pretty similar to an old-school mutual fund, but the average fee, it's almost cut in half. We're talking 0.64% versus 1.08%. For most people, that's a no-brainer. The other big product revolution is all about cracking open a world that used to be exclusively for the super rich. Private markets. You know, things like private equity, private debt, real estate, stuff that was off limits. Now, firms are scrambling to design funds that give everyday investors a piece of that action. And the prize for getting this right? It's enormous. These alternative assets generate over half of the industry's entire revenue. Okay, so innovating is one thing. But what if you can't build all these new products fast enough? Well, that leads us directly to the second force. And the answer is simple. You buy them. The industry is right in the middle of a massive wave of mergers and acquisitions. And this isn't just about getting bigger for the sake of it. These deals are super strategic. Firms are essentially going shopping for the capabilities they can't build themselves, access to those alternative investments, cutting-edge new tech, and maybe most importantly, a direct relationship with you, the customer. It's a race to get bigger, smarter, and closer to the money. And this brings us to the third and honestly perhaps the most critical force of all, a radical, top-to-bottom rethink of their costs. At the very heart of this is a philosophy called zero-based costing. And it sounds pretty intense because it is. Instead of just tweaking last year's budget, every single expense, from salaries to software subscriptions, has to be justified from scratch every single year. It forces some ruthless decision-making. So, in practice, this zero-based thinking leads to three key moves. First, you outsource anything that isn't your absolute core strength. Second, you automate everything you possibly can with new AI tools. And third, you streamline the whole organization to get rid of redundant teams and overlapping jobs, which is especially important after a merger. This isn't just trimming the fat, it's redesigning the entire business from the ground up. Now, all this cost pressure is basically forcing firms to pick a lane, to decide what kind of company they're going to be. The first model is what we can call the alpha house. These guys are the specialists. They focus relentlessly on one thing, generating alpha, which is just a fancy way of saying market-beating returns. And you can see it in their spending. Their biggest cost at 39% is poured directly into elite investment teams and trading technology. The second model is the total opposite. It's the beta factory. Think of the giants in passive investing. They do a complete 180. They strip their investment costs down to the bare minimum and instead pour money into technology. For them, tech is the biggest expense. Their whole game is about maximum efficiency and massive scale to offer the lowest cost products possible. And finally, we have the distributor. Now, these firms are interesting. They've realized that owning the customer relationship is the most important thing. So their spending is heavily focused on sales, marketing, and operations. They focus less on creating the products and more on being the absolute best platform to connect investors with the right solutions no matter where they come from.
So, what does this all mean when you put it together? Well, the main point is this. This isn't just a normal cyclical recovery for the asset management industry. It is a fundamental reshaping of everything.
Yeah, the industry isn't just bouncing back, it's literally changing its DNA. These three forces, product innovation, consolidation, and this radical focus on efficiency, are creating a permanently different landscape. The old way of doing business, it's pretty much over.
And that leaves us with one final thought. As the lines start to blur between public and private assets, and between getting advice from a human versus an AI, we all have to ask ourselves a new question. In this completely reshaped world, what will you demand from the firm that's managing your money?